Good afternoon, everyone. This is Campbell Delahoyd with the National Association of State Energy Officials. Thank you for attending this year's Winter Energy Outlook webinar hosted by NASEO and the Energy Information Administration. A few housekeeping items before we get started. First, this webinar is being recorded and will be posted to the NASEO YouTube channel later this week. So if you're unable to attend, please feel free to look at that. We'll follow up with all attendees with the link. Second, all audience members will be muted. This is a webinar, so if you do have a question at any point throughout the session, please feel free to enter it into the question box, and we'll get to it as we can per each presenter's allocated time. There will also be an additional question and answer session at the end of the webinar. So with that, I'm going to pass it off to NASEO's Executive Director, David Terry, for some opening remarks. David?
Thank you, Campbell, and welcome everybody today. I want to thank the U.S. Energy Information Administration for their support and participation today, as well as DOE's Department of Energy's Office of Cybersecurity, Energy Security, and Emergency Response, CESER, who we work with closely on many of the topics being discussed today and in follow-up as well. I also want to welcome all of the state energy offices, state, territory, and District of Columbia energy offices across the country for participating today. They are our core members and who we support and work with, and your private sector partners, as well as many of the Department of Energy offices that are on the line, other federal agencies, really every energy sector you can imagine represented, gridded pipelines, transportation, end use, homes, businesses, et cetera. So we thank you all for joining this year. The EIA NASEO partnership goes back a long way, in fact, about 40 years. I think always prominently of the former Florida Energy Director about 30 years ago, Jay Hakes, who was the EIA administrator at the time, and really brought a state data focus to the agency. And I think EIA has built upon that success over the years and really made the data more and more user-friendly as time goes by for our members and for all the folks that are with us today. Data is really at the core of what the state energy directors do on behalf of their governors and legislators and their constituents for planning, for energy emergency response, for energy programs, for policy, both end use and energy production and distribution. EIA data is supplemented, and you'll hear much of that in today's event, by private sector experts. Ed Morris from Citi is one example. We have others on the line that really bring their critical eye and analytical capabilities to bear in a way that adds additional value and perspective on all the data we'll be looking at today. Weather is, of course, the wild card. Not all of the conferences focused on weather-related issues and what it means for homeowners and businesses in terms of energy prices and supplies, but there's a good part of it that we do. And I have a farming background, and I won't go through the things that we use to judge what the winter would be, but let's just say a flip of a coin would probably be about as accurate. So we're glad we have the National Oceanic and Atmospheric Administration, NOAA, here again to provide some real expertise and outlook to the best of their ability with their forecasting capabilities. So really well-rounded. It's one of my favorite events we do every year, and just pleased everybody can join us, and particularly pleased that our Energy Committee co-chairs can kick us off with a little discussion in their perspective, Ben Bolton from Tennessee and Megan Levy from Wisconsin. So without further ado, I'm going to turn it over to you, Megan and Ben. Thank you.
Ben, you're muted. Thank you so much, David. We'll go in alphabetical order this time.
All right, thanks, David. And I know at some points we used when we saw the fuzzy caterpillar as one of the indicators of what the weather is going to be around here. But in Tennessee, we don't quite have the winters that a lot of my colleague in Wisconsin has. But I will say, as I like to usually start with these kind of things, it's day 595 of being activated since for COVID, just to remind folks of how long we've been doing it and getting through it. And I'll keep my remarks short because we've got a lot to cover and a lot of wonderful people to hear from today. But the main thing that 2020 and now 2021 have taught us is our supply chains are a lot more fragile than we anticipated. And we are seeing energy sector issues pop up all over the globe that have direct repercussions for the U.S. So it's something that we can't be insular about and not have a wider perspective, even all the way down to the state level of a fire at a plant in Germany may affect fuel and some things in Tennessee at a fuel terminal in Knoxville. Hard to believe the two are connected, but here we are. So with that, I will hand it over to Megan.
All right, thanks, Ben. And I'll keep my remarks short as well, because we've got wonderful experts, and my dog is keeping her remarks right on time. But I did want to underscore the importance of the Climate Prediction Center. You know, weather is so important, but it's all of these moving parts in our interconnected society that I think we'll be excited to hear about, particularly from Ed Morris from Citi, from our colleagues from Rusty telling us more about the propane market, and also specialists from the Energy Information Administration. And I do appreciate David's point about when EIA really turned to that state energy data set and how incredibly useful that is for us, not only day to day, but in our energy security strategizing. It is invaluable. So thank you so much, everyone, for joining us today. And without further ado, I'll turn it over to Mr. David DeWitt. He's the director of the Climate Prediction Center for the National Oceanic and Atmospheric Administration. David?
Great, thanks. So as Megan said, I'm Dave DeWitt. I'm the director of NOAA National Weather Service Climate Prediction Center. It's a great pleasure to be here with you, briefing you about the winter outlook. Next slide. So here's a brief outline of the topics I'm going to speak to. So first, I will give some background information on the CPC seasonal outlook for those who are not familiar with it. Then I'll review last year's outlook as well as what actually happened. Then I'll discuss the major climate factors that impact U.S. winter temperatures and show that what these factors are likely to look like for this year. And then finally, I'll give this year's winter outlook. But I do want to highlight that we update the outlook every month. And in fact, this Thursday will be the next update. And then I believe the next update after that would be November 18th. Next slide. So I'm going to start by briefly covering the sources of seasonal climate predictability. These include persistent or recurring atmospheric circulation patterns such as the El Nino, La Nina, the Arctic or North Atlantic oscillation, and the Pacific North American pattern. There are others. These are some of the major ones that impact North American winter weather, El Nino, La Nina being the dominant one. Anomalous boundary conditions such as sea surface temperature, sea ice, and soil moisture that have the ability to hold heat and transfer to the atmosphere are also important. And finally, trends are important, whether or not they're caused by greenhouse gas emissions or some other phenomena. Low frequency trends exist and in fact are frequently an important part of our predictive skill. Next slide. So how does, oh, we're up one too far. Could you go back one? Thanks. Yeah. So how does CPC make our seasonal outlooks? We use what the Net Weather Service would call a human over the loop process. So in this process, the forecaster synthesizes information from a set of well-vetted prediction tools. The tools are both statistical and dynamical in nature, and they're objectively combined into what we would call a first guess or a consolidation. The forecaster then takes this consolidation and reviews his thought process in terms of maybe the models have not performed as well in recent years, or maybe there's some other factor that he thinks is relevant, and then that's vetted by a whole team of people inside the center, as well as other experts across the center. Next slide. So actually, if you could go back one, sorry, we seem to be out of sync here a little bit. Yeah, so the seasonal outlooks are prepared for the average temperature and the total accumulated precipitation. They're given in tercile probability categories, 3 categories, below, near, and above normal. The regions where the likelihood of the 3 is equal is called equal chances. You could also consider that to be low predictability. It means that we can't distinguish a signal one way or the other. The shaded regions on the maps give the probability of the dominant category. We also have available on our website interactive maps that allow you to sample the full probability distribution, at least in terms of the 3 classes for a particular location. There's another tool that you can actually get the probability of exceeding particular values. That's called a probability of exceedance tool. Next slide. So here's an example of a forecast. And so the red, so let's just concentrate on the left for temperature. The red shading region in the southern part of the country, that's for above normal. Here you can see for North Georgia that the tercile classes below, near, and above normal. And then the blue shadings are for above normal, below normal temperature. In this case, for Northern Washington, we're showing below, near, and above normal categories with the breakdown there that you see. So again, when you're looking at the map, generally speaking, all you're really going to see is that shading. If you wanted the information for the tercile class, you would have to go to a separate link to get the information available for a particular location. Next slide. So the Outlook is issued, as I say, once per month. It's actually issued every third Thursday. The next one will be October 21st. The final winter Outlook will be November 18th. And there's always a 2-month overlap. So there's a fairly good amount of consistency between the outlooks. You get a continual evolution over the 13-month period that the outlooks are available for. Next slide. So now I'm going to talk about the forecast from last winter, the 2021 forecast that was briefed to you last year by my deputy, Mike Halpert. And I'll start off by saying it was not a successful forecast, even in the sense that these are probabilistic forecasts. And I'll talk a little bit about why it was not a successful forecast and the factors. And it's always important to remember that these forecasts are probabilistic because this is a small signal, large noise problem on these timescales. Next slide. So the large scale drivers, climate drivers for last year were a forecasted moderate strength La Nina, positive trend in the Arctic Oscillation, and a warming temperature trend across the south and along the east coast. Next slide. So in terms of what the sea surface temperature looked like, this is the equatorial Pacific, and this blue region represents below normal temperatures. The box indicates a key region called Nino 3.4, and the SSTs were below normal of sufficient magnitude that it was classified as a weak La Nina. That's as we were giving the briefing last year. Now the La Nina was a good forecast that did materialize. Next slide. And the way that we get the La Nina forecast predictions are using what we would call a multi-model ensemble, given the inherent uncertainty, both in terms of actual constraints in the physical system, as well as model inaccuracies. We use several different models, in the left-hand case, many models to get a probability space. On the right is a smaller set of models, just dynamical models from a tool called the North American Multi-Model Ensemble. Yeah, in both cases, it was indicating that we were going to have a moderate strength El Nino that would continue throughout the winter. That actually verified very well. So that was not the source for the low predictability last winter. Next slide. So the forecast that we gave you from last September shows a canonical or typical temperature response to La Nina conditions, which reinforced by the trend. The dynamical model forecast from the North American Multi-Model Ensemble also had a similar pattern. And as you can see, the typical La Nina pattern is for warmer temperatures for the southern part of the country and colder temperatures for the northern part of the country. Next slide. Next slide. Yeah, so here's what actually happened. And again, this is observations put into a very simple format. This is, again, represented by the tercile class. So red is below normal, gray is near normal, and blue is above. Blue is below normal, gray is near normal, and red is above normal. And the score for our forecast, which from the previous slide compared to this, is -22. That's not a good score. Heitke skill score of 0 is considered to have no skill. Positive values have some skill. So let's talk a little bit about why this didn't work out. Next slide. And I'll just briefly go over, actually, let me briefly go over the precipitation forecast. So the precipitation forecast, also a canonical La Nina pattern, was for below normal in the southern part of the country and above normal in the northern part of the country. And Heitke skill score of 0, so on the borderline of useful skill versus not. So in terms of why the forecast didn't verify well for temperature, there were two what we would call sudden stratospheric warmings that occurred in winter, actually in the later part of the winter. When that occurs, you can get a very active polar vortex, which allows colder air to spill down over the country. Next slide. And when that does happen, if you're forecasting, as we did, a canonical La Nina response, you're not going to be able to do very well, because we're not going to be able to pick up that higher frequency variability that comes from that sudden stratospheric warming. Sudden stratospheric warmings, their initiation is only forecastable on about a 2-week lead time scale. Their impacts will last for several months, but if you're not within that 2-week lead period, then you're not going to be able to pick up that impact. So forecasts that were made later in the winter actually did show that cooling, and those later forecasts were actually more successful. But of course, we're trying to forecast now in September and October, and that's a much longer lead than 2 weeks for the December, January, February period. Next slide. So now I'm going to talk about what are the sources of seasonal predictability. And of course, we've already talked about the fact that the El Nino La Nina is an extremely important seasonal climate phenomenon, has a lot of teleconnections or remote responses associated with it. Other phenomena that are not as well understood are the Atlantic Oscillation or Arctic Oscillation, North Atlantic Oscillation, and the PNA. There's also climate change or decadal variability, and there are anomalies in large-scale oceanic circulation, such as the Atlantic Meridional Overturning Circulation, or AMOC. Next slide. So again, in terms of how we make the forecasts, we make them based on using both statistical and dynamical tools. Forecaster uses a human over-the-loop process. We have an objective combination based on historical skill for the different tools, and they're weighted based on their historical skill. And then the human weighs in any particular factors he or she may believe may be relevant in this particular instance. And then we vet the whole thing through our team, as well as other external experts from NOAA. Next slide. So where are we at right now in terms of conditions? So again, similar to last year, here we are in the beginning of October. We have La Nina conditions. In fact, we've just declared a La Nina advisory. We're expecting that this La Nina will continue at about this strength, or strengthen a little bit more to perhaps moderate La Nina strength conditions. Next slide. Here are the other SST indices. Skip that for now. So again, coming back to these multi-model ensembles of sea surface temperature predictions that we use, on the left is what we call the IRI CPC product that's produced in collaboration with our colleagues from Columbia University at the International Research Institute for Climate and Society. On the right, again, is the North American multi-model ensemble. And so as we see, the winter is projected to be another weak to perhaps moderate strength La Nina. And so based on canonical responses, we would expect the temperature pattern that we had predicted last year that I've mentioned actually was not verified very well because of the fact that we had the sudden stratospheric warming. But the pattern you'll see when I give the outlook will be very similar to what we forecast for last year. Next slide. So in terms of what you normally expect from a La Nina, this is what we would call a composite. On the left, we have the composite and the trend. And again, this gives a general sense that for the southern part of the country and up through the East Coast, because of the trend, we expect warming, whereas in the central part of the US and the northern part of the country, especially the Northwest US, we would expect below normal temperatures for the winter. Next slide. So in terms of other sources of predictability, the North Atlantic Oscillation actually at very short leads can be predicted. It's not very well predicted at leads beyond a couple of weeks, has a major influence on temperatures in the United States, especially for the East Coast. We hope one day to be able to predict it better. There is some evidence that, in fact, it is linked. Switches between signs of the NAO or the Arctic Oscillation, which is another name for a closely related phenomenon, are somewhat related to variability in the stratosphere, or can be excited. Different modes can be excited by variability in the stratosphere. And so, you know, as we start to work more and more on things like stratospheric predictability, we hope we might be able to do better in predicting the North Atlantic Oscillation or Arctic Oscillation. Next slide. So here again, just showing the fact that over the last many years, there was a positive NAO or AO, and that generally results in a pattern of warming over a large part of the country. Last year in the winter, as represented on the far right there, you see there was a large negative period. That was the winter, and that was largely caused by this these couple of sudden stratospheric warmings. So that was actually the first time in 8 years that we had a sustained AO, negative NAO for the winter season. Next slide. So another tool that we use is called the optimal climate normals. The optimal climate normals are a short-term trend. So we're trying to look to see if there's a 15-year trend in the data. And the general trend for the United States is warming along most of the coasts and the southern part of the country. Next slide. And you can see here that the trend that we're forecasting for this particular year using this tool again has warming over some of the West Coast, a large part of the East Coast, and at least the southeastern part of the US. Next slide. Next slide. So the forecast coming for this winter from the North American Multi-Model Ensemble calls for above average temperature over almost the whole CONUS. There's a small region along the West Coast and on the northern tier where it's neutral. But again, also favoring here above normal temperature for a large part of the country for this upcoming winter. Next slide. So now I'll give you the outlook. Again, this is the outlook that was issued in September. We will update this outlook this Thursday and then again on November 18th, I think. Next slide. So in terms of how we arrived at the outlook, again, the La Nina conditions are now declared. We're now in a La Nina advisory, and we're expecting with an 87% likelihood that that will continue throughout the winter. We also have the temperature trends that I've shown you before. These are relative to the 1991 to 2020 period and show warming along the East Coast and the Southeast and some warming up along California. So the forecast that we have is very consistent with the canonical La Nina and the model guidance, especially the North American Multi-Model Ensemble, which is our best single tool in terms of its predictability and predictive skill, as well as the long-term trends. Obviously, as we go forward in time, we will adjust things. Given the fact that we have the La Nina at present, the adjustments are likely to be small unless there were a major change in conditions, such as, for instance, if we were to have a sudden stratospheric warming now, that would influence conditions going forward. Or, for instance, if it were to occur in late December, that would influence our prediction going forward from that point. Next slide. So in terms of the outlook, you can see that along a large part of the eastern United States, we're forecasting for above normal temperatures or probability of above normal temperatures. The only region with a modest probability of below normal temperatures is the northwestern US. And then there is this region in the central part of the country, north central part of the country, where we're calling for equal chances. And again, when you see equal chances in a seasonal forecast map, what that really says is low predictability. We're not able to get a shift in the PDF one way or another based on the climate drivers. Next slide. So in terms of what we're looking at with regard to strength of the temperature anomalies, these are about half as strong as last year. And so you see that the maximum anomalies that we're forecasting for at the 50% probability are on the order of 0.6 degrees Fahrenheit over this region. That's given by that fairly dark red shading. The other shaded regions are also given their values in the color bar. Up in the northwestern United States, we're forecasting a very small region with a 50% likelihood of temperatures being minus 0.4 Fahrenheit or greater. But again, not a very large region being forecast for below normal temperatures here this winter. Next slide. So in terms of the precipitation outlook, again, very much a canonical or typical La Nina response here, with below normal precipitation for the southern tier of the country, especially Southern California and Florida, and then two lobes of forecast for enhanced probability of above normal precipitation, northwestern US, and then the Great Lakes and Ohio Valley, and then a large region where there's much less predictability based on the current climate drivers, and when we turn that equal chances on our maps. I should note that the temperature and precipitation maps may look different to you, and I had shown earlier what last year's predictions looked like, and that's because we recently updated our outlooks. Hopefully you find them more useful and easier to interpret. We had engaged a social science study in order to get the product to be better interpreted or more easily interpreted by stakeholders such as yourself. So if you have feedback, we'd be happy to get that. Next slide. So in terms of the next 6 months of predictions, those are given here. So this is for November, December, January, through next April, May, June. I should note that on the website, you can actually get out to the next 13 months. So these 6 maps will be updated again this Thursday. And then every third Thursday, they would be updated. You can get the rolling 13-month predictions. Not much change over this period as the La Nina conditions are anticipated to continue. And so a lot of warmth for the southern US and the east coast of the US, and then a region of lower predictability in the northern part of the country. And depending upon the particular season, a small region of enhanced probability for below normal temperatures in the northwest US. Next slide. Yeah, I think that's actually the last one. So sorry, I went over a little bit, and also my apologies that I got disconnected there on my slide cadence. I think I changed my slides after I sent them to you, which was bad on my part. So sorry about that.
Quite all right, David, and thank you very much for that briefing. We do have a few questions. One of the ones was asking about weather reports and forecasting, but I think you sort of touched on that as far as predicting and how that could go, because they were getting into how do we keep getting so many inaccurate weather forecasts. And since this one's focused more on the larger climate trend for that time period, I think we'll sort of stick with that one. There was another one though that said, that was asking in the chat, can we predict or recognize the next polar vortex before or as it begins to form? Like about how many days in advance can we successfully predict those at this point?
Yeah, so just I'll make a quick comment, which is the polar vortex always exists. That's just a standard phenomena. Whether or not you're going to get wobbles in it, what state it's going to be, whether you're not going to be able to bring that cold air down, we're able to predict those events, initiation of them on the order of 10 to 14 days, and not longer than that at present. Unfortunately, it's really a complicated fluid dynamics problem.
Thank you. And then we had another question from Jim Moore. What kind of impact has the 30-year normal update earlier this year, the move from 81 to 2000, I guess that's 11, from now shifting 10 years later to 1991 to 2020?
Yeah, so what ends up happening, obviously, given the fact that we've had this long-term warming trend, is the climatology is warmer. And so you tend to get some more cold air than you would have had in the past. And generally that lowers skill a little bit. Predictability for cold air outbreaks on these timescales is lower than it is for warm air on a seasonal timescale. And that's also due to the fact that the trend is positive. And so the trend is always a background state. Where it's larger or smaller varies geographically, but it's always positive. And so that gives you an extra tool in your toolbox with respect to skill. You don't have that with respect to below normal.
Okay, and we'll take, I think we've got time for one more to stay on track. What's the weather, does NOAA include Gulf Stream factors in your modeling?
Yeah, so when I talk about these North American multi-model ensembles, those models are complicated atmospheric oceanic dynamical models. And so there's a full ocean circulation and includes the meridional overturning circulation as well as the Gulf Stream and other phenomena like that.
All right, thank you very much, David. And I certainly, as always, appreciate NOAA's work that y'all do and help us to predict for the winter as best that you can. We all do understand that it's a prediction, and things will change as we get through the actual winter. So thank you again. And we'll move on now to Tim Hess with EIA. He will be presenting our winter fuels outlook. And then he'll also be joined by Warren Benkeski. He's one of the lead industry economists with EIA, also to help answer questions specifically about propane if we have some after that session.
Hello. Yeah, thanks, Ben. And thank you to NASEO, as always, for hosting this conference. It's always an important conversation to be a part of, but it's years like these where prices are high that remind us just how important these meetings are. I would also like to thank the many analysts and staff at EIA who provided critical input and analysis to this report. Our Winter Fuels Outlook is a cross-cutting EIA product. And specifically, this report wouldn't have been possible without the work of Karina Ricker on natural gas, Sean Hill and Matt French covering heating oil, Warren Wilczewski was on this call, and Josh Ironman covering propane, Tyler Hodge covering electricity, and Owen Comstock, who put together this year's slide deck. So thanks to everybody at EIA for all the work. And just to EIA, just for note, EIA is the statistical and analytical agency within the U.S. Department of Energy. By law, EIA's data and analyses and forecasts are independent of approval by other officers or employees of the U.S. government. The views in this presentation, therefore, should not be construed as representing those of the U.S. Department of Energy or other federal agencies. The report's been out for about a week now, and you can go ahead and advance the slide, please. The report's been out for about a week now, so some of you might have already looked through it, but in general, EIA expects that households across the United States will spend more on energy this winter compared with the past several winters. The higher expenditures largely reflect our forecast that retail energy prices, which are at multi-year highs heading into this winter, will remain above levels from recent winters. We also expect temperatures this winter to be slightly colder than last year, contributing to a bit more consumption. The high prices heading into this winter are resulting from changes in the supply and demand of crude oil and natural gas following the most severe periods of the COVID-19 pandemic. Although price increases over the past year can be attributed to several factors, the main reason wholesale prices of natural gas, crude oil, and petroleum products have risen is that fuel demand has increased from recent lows faster than production. This dynamic has led to falling inventories, as in the case of crude oil and several petroleum products. And inventory is increasing by less during the summer than the historical average, as in the case of natural gas and propane. Next slide, please. Before we get into the detailed finding, it's important to set out some key definitions and methodologies of the winter outlook. First, when we talk about the winter in this outlook, we're referring to the October through March period. Second, we group homes by primary heating fuel. For example, a home that heats primarily with an electric heat pump and also supplements that with a wood-burning stove would be included in the electricity category. However, the expenditures report would be for the entire utility bill for that fuel. For instance, expenditures for that house that heats primarily with electricity would include electricity used for appliances and lighting. Because electricity has the widest range of household uses among the fuels, electricity consumption in this report tends to be less sensitive to changes in temperatures than other fuels. Finally, we use housing characteristics from EIA's Residential Energy Consumption Survey, or RECS. And these are averages for houses that use these specific fuels. But expenditures for individual homes depend on the size and energy efficiency of the individual homes and their heating equipment, along with thermostat settings and localized weather conditions. Next slide, please. So why do we talk about winter fuels? In general, that's when households use the most energy and can face the highest utility bills. For each of the 4 fuels we cover, these graphs show the range of residential consumption by month over the past decade, with the line in the middle of the range representing the 10-year average. For all fuels but electricity, household fuel consumption peaks during the winter months. Next slide, please. Heating fuels aren't used uniformly across the country. The map on the left shows the most prevalent heating fuel in each state, and the right-hand set of maps shows the percentage of homes by state that use each of the 4 fuels covered in this report. Almost half of US households heat primarily with natural gas, and its use as a heating fuel is widespread across the country, with the biggest concentration of users in the Great Lakes, Mountain West, and California. Electricity is also widely used to heat homes, with the highest concentration of electricity use in the Southeast and Northwest. Heating oil and propane both account for about 5% of US households, and their use is more regional. Heating oil is almost exclusively used in the Northeast, and propane use is concentrated in the upper Midwest. Next slide, please. As I noted at the beginning of this presentation, we expect expenditures for all fuels to be up across the US this winter compared with last winter and with the past several winters. Changes in heating fuel expenditures mostly reflect 2 factors. First, changes in temperature, which affect how much fuel is needed to keep a house warm. And second, changes in the price paid for that fuel. This year, our forecast of higher expenditures mostly reflects higher expected prices. On average, across the US, we expect households who use propane and heating oil will experience the biggest increase in expenditures compared with last winter. In our outlook, households that use propane could experience a 54% increase in expenditures on average, and households that use heating oil, a 43% increase. Increases for heating oil and propane are more than for natural gas and electricity, because the pass-through of rising wholesale commodity prices happens more directly and more quickly in heating oil and propane markets than under the rate structures prevalent in electricity and natural gas markets. This effect can be seen by the more volatile year-to-year expenditures for propane and heating oil. Even though we expect higher bills for heating oil and propane this year, we expect expenditures to be similar or lower than a decade ago when crude oil was trading near $100 per barrel. We also expect natural gas price increases to be more than in past years, leading to expenditures that are a forecast 30% higher than last winter. For electricity, where price pass-through happens the slowest, we expect households will spend 6% more this winter compared with last winter. Next slide, please. These graphs show the regional price trends for heating fuels over the past winters. On the left-hand graph are natural gas prices. We expect retail natural gas prices to be up this winter because of steadily rising prices over the past year for wholesale natural gas at Henry Hub in Louisiana, the US benchmark. Henry Hub prices are starting this winter up about 84% from last winter's average. On the second graph, you can see that electricity prices tend to rise gently year over year, but this year we do see electricity prices increasing by 5%, a big increase compared with recent winters, which mostly reflects the higher cost of natural gas to power generators. The price changes for heating oil and propane mostly reflect rising crude oil prices, which are starting the winter above $80 a barrel, about 50% higher than last winter's average. We expect propane to experience the biggest price increases among the fuels. And although we expect propane expenditures to rise in all regions, propane prices are fairly different across the regions, with the highest prices in the Northeast and the lowest prices in the Midwest. Next slide, please. In addition to price, weather is the other key determinant of winter heating expenditures. EIA, I don't know that is rendering, the graph is rendering quite correctly there. EIA uses heating degree day forecast from NOAA as the baseline weather in our winter fuels outlook. Our outlook was based on NOAA's forecast published in mid-September. Note that when I discussed the heating degree day outlook we use compared with what was shown in the presentation by NOAA, the numbers might be a bit different. And this reflects a couple of factors. First is that EIA takes state level data and reweights state level heating degree data from NOAA and reweights by current population estimates. Also, the comparison period differs. What I've noted here is that our forecast includes more heating degree days this winter compared with last winter, where the slides shown by NOAA are compared with a 30-year normal. So that's part of the difference. You know, both this winter and last winter would have fewer heating degree days, or slightly warmer weather than the 30-year normal, but this winter has more heating degree days in the forecast than last winter. Cold weather can affect household heating expenditures in two ways. First, it raises the amount of energy required to keep a home at a specific temperature. And second, because it raises demand and could cause supply disruptions, cold weather can cause energy prices to rise, a development that can be more acute in times of low fuel inventories. Our forecast based on NOAA's outlook is that the US will have 3% more heating degree days this winter compared with last winter, and a similar number of heating degree days to the average of the past 10 winters. Most winters end up being within about 10% of the initial forecast. And because of this, EIA runs scenarios in which temperatures are, or where there are 10% more heating degree days, 10% colder, or 10% fewer heating degree days, which would be warmer than our initial forecast. Next slide, please. This slide shows the resulting expenditures in those scenarios and demonstrates the importance of how cold or warm a winter ends up being to resulting expenditures. For natural gas, compared with our baseline forecast of 30% higher expenditures compared with last year, as shown on the earlier slide, we expect that increase would be 50% in a colder scenario and 22% in a warmer scenario. For heating oil, expenditures in the forecast rise by 59% from last winter in the colder scenario, but rise 30% in a warmer scenario. For electricity, our forecast expenditures rise 15% from last winter in the colder scenario, compared with 6% in the baseline, but rise just 4% in a warmer scenario. Propane could see the widest range of outcomes. Our forecast expenditures rise 94% from last winter in a colder scenario, but rise 20% in a warmer scenario compared with the 54% baseline. Next slide, please. So I'll show a series of these slides for each fuel that details the regional expenditures. The left-hand column shows a regional breakout of where the fuel is used. And then the middle column show consumption and retail price this winter, and the change in percentage terms from last winter. And then the resulting expenditures are the right-hand column. Expenditures for natural gas tend to be the highest in the Northeast in a dollar amount, where prices are the highest, and also in the Midwest where consumption is the highest. For natural gas, we expect most regions, except the South, will see a 3% increase in consumption this winter compared with last winter. For prices, we expect the largest increases in prices and expenditures to be in the Midwest, where changes in wholesale natural gas prices tend to show up more quickly in retail rates. For the Midwest, we expect expenditures to be up 48% compared with last winter, with expenditure increases closer to 20% in other regions. Next slide, please. So as I noted earlier, the and I apologize, these slides are not rendering correctly. Ben, do you okay, I'm hearing it. It does look good. Okay, maybe it's just my screen. I apologize. So okay, as I noted earlier, the main driver of rising natural gas prices as we've emerged from the COVID-19 pandemic is that demand for natural gas has grown more quickly than supply. And the easiest way to see this dynamic is in inventory levels. In the US natural gas market, inventories typically build from April through the end of October or early November in order to have supply for the winter. This year, those inventory builds have been less than the 5-year average, although builds over the past month have been above average. This graph shows natural gas inventories in history and our forecast. And the gray area is the range from the past 5 years, with the light gray line that runs through the middle of the 5-year average. The dotted lines show our inventories in the 10% warmer and colder scenarios. Next slide, please. Another way to look at this picture is the difference to the 5-year average. Shown here, the respective is the difference to the 5-year average. Right now, natural gas stocks are about 5% below the 2016 to 2020 average. In our base case, we expect stock draws this winter to be a bit more than average, but we expect inventories to remain in the normal range of the past 5 years. However, in the 10% colder scenario, we would expect to see inventories fall significantly more than is typical and end the winter at the lowest level since 2014. In this scenario, we would expect Henry Hub prices to be higher than our forecast. In the warmer scenario, we expect natural gas inventories would end the winter near the 5-year average. Next slide, please. Natural gas exports have grown in recent years and become a more important part of our domestic energy market. This graph shows the averages for US benchmark Henry Hub prices compared with prices in major natural gas importing markets in Europe and Asia. As this graph shows, US exports have been supported by very high prices in international markets. US prices have also risen in recent months, but by less than global prices. We expect that US natural gas exports will be up 15% this winter compared with last winter. That's including LNG and pipeline. We also expect that US LNG export capacity will be operating at 100% utilization in the coming months. So, and we expect any increase in exports this winter to come from some facilities coming out of maintenance during the autumn and the startup of some new LNG export trains and another factor that has affected US natural gas markets heading into winter is switching between coal and natural gas for electric power generation. Electricity generation from coal-fired power plants has not increased as much in response to rising natural gas prices as it has in the past, or by as much as our model forecast in recent STIOs. The lower price responsiveness of coal for electricity generation, which is likely the result of constraints in the coal market, is likely contributing to upward pressure on natural gas prices. We forecast Henry Hub natural gas spot prices will average $5.67 per million British thermal units this winter, before declining to an average of about $4 per million British thermal units for all of 2022. However, implied volatility in the futures market has been running at very high levels, suggesting natural gas market participants see a wide range of possible price outcomes. Next slide, please. This table shows our outlook for electricity expenditures by region. We expect consumption to be up about 2% in most regions compared with last year, and unchanged in the South. Increases in electricity retail rates range from 1% on the low end in the West to 7% on the high end in the Northeast. For the resulting expenditures, we expect consumers will face the biggest increases in the Northeast, with expenditures forecast to be up 10% compared with last winter. Expenditures in the West are forecast to rise by 3%, which would be the lowest among the regions. Next slide, please. Switching to propane, for propane, we look at the Northeast, Midwest, and the South. Similar to other fuels, we generally expect propane consumption to increase by 2%, to increase by about 2 or 3% compared with last year. However, we expect propane will see the largest price increases among the fuels, up 42% in the Northeast and South, and up 65% in the Midwest, which leads to our forecast that propane expenditures in the Midwest will rise by 69% this winter compared with last winter, the most among the regions. Despite the forecast increases in the Midwest, we still expect that households in the Northeast will see the highest expenditures for propane this winter because price levels are the highest in that region. Next slide, please. This graph is similar to the one I showed for natural gas, and it shows propane inventories compared with the range from the past 5 years and in the colder and warmer scenarios. US propane inventories are starting the winter about 20% below the 5-year average, and weather will be key to inventory and price formation in propane markets this winter. If weather ends up being in line with the base case, we expect propane inventories will experience a fairly typical seasonal draw this winter. However, in the 10% colder scenario, we forecast propane inventories would end the winter at the lowest level on record in EIA's data back to the early 1970s. This situation could put upward pressure on wholesale propane prices that would be passed along to consumers when they have to refill their tanks, which is required more often in the cold winter. Next slide, please. The US propane market is fairly regional, and the regional inventory picture matters for winter prices. The graph shows regional inventory levels compared with their respective 5-year averages, the dotted lines. About 80% of US propane is stored in the Gulf Coast and in the Midwest. Inventories on the US Gulf Coast haven't built as strongly as normal this summer. The US Gulf Coast is the center of the US petrochemical industry and a major propane export center. It is also the location of the US's main benchmark price at Mont Belvieu, Texas, near Houston. Low inventories for propane reflect high global demand for US exports because of rising consumption in the petrochemical sector globally, for which propane is a key input. However, global propane supplies have also been limited because of the OPEC plus crude oil production cuts, which have reduced the supply of associated hydrocarbon gas liquids, including propane. Next slide, please. So this graph shows propane spot prices at major international hubs. Propane prices have risen steadily across the globe since early 2020, with the increases over the past month particularly sharp. Note that prices at the Mont Belvieu hub are typically less than in Europe and Asia, a condition which reflects demand for US propane in those markets and supports US exports. Next slide, please. This graph shows the high demand for US propane I was discussing, with gross exports represented by the area in the positive portion of the graph and gross imports in the negative portion. The resulting net exports are the dark line. In our outlook, we don't forecast propane exports and imports separately, only the net trade number. We expect net propane exports to remain above 1.2 million barrels per day in most months this winter, as strong global demand for petrochemicals remains. However, increasing production from OPEC plus countries as they relax production cuts could increase global supplies and take up some of the demand for US exports. Next slide, please. And we'll finish here on heating oil. For heating oil, we only provide a US average number, but this number is mostly representative of households in the Northeast, which consume about 80% of US heating oil. Like the other fuels, we expect high prices to be the main driver of rising expenditures this winter, with a forecast 33% increase in retail heating oil prices. We expect that households will spend 43% more this winter for heating oil compared with last winter. Next slide, please. Higher heating oil prices this winter are largely the result of rising crude oil prices and, to a lesser extent, rising wholesale margins, the difference between the price at which refiners sell heating oil into the wholesale market and the price at which they purchase crude oil. This graph shows the three components that make up the retail heating oil price on a quarterly average basis. Brent crude oil prices are currently trading above $80 per barrel, which is up more than 50% from last winter's average. The increase in Brent prices largely reflects a steady decline in global oil inventories compared with last winter. which is the result of global oil demand that has risen as the global economy has expanded. This demand growth has occurred amid restrained production levels from OPEC plus countries and US crude oil production that remains below pre-pandemic levels. We expect Brent crude oil prices will stay above $80 per barrel in the fourth quarter of 2021, before crude oil production increases from OPEC countries and growth in US shale oil, coupled with decelerating growth in global oil demand, will begin to contribute to downward oil price pressures in early 2022. Next slide. Similar to other fuels we've discussed, US distillate fuel inventories, a category that includes heating oil, but is mostly diesel, are beginning the winter at relatively low levels. This graph is for the US as a whole, but distillate fuel inventories in the Northeast, the key market for US heating oil, totaled about 27 million barrels on October 1st, 30% less than the 5-year average. Because heating oil is a relatively small part of the overall distillate fuel market, weather has much less of an effect on inventory levels during the winter than it does for natural gas or propane. So that, next slide, please. That concludes the presentation. Again, I also apologize for going slightly over time, but I wanted to note that EIA also has other heating oil and propane resources available as we go through the winter that we'll be updating each week with important data that we survey and links to resources in those markets. So with that, thank you.
All right, thank you so much, Tim. And I'm so glad that you brought up the state heating oil and propane pricing survey. That's something that I know both Ben and I participate in, and it's gives us incredibly valuable data. Well, I think everyone saw it writ large in the slides. Propane users, of which we have more than 250,000 in Wisconsin, are going to be feeling it this year. And we've got some great questions in the chat. So, well, Warren, thank you for answering some questions in the chat on the live. But for Tim, from our colleague Paul Holloway in Massachusetts, asking about LNG exports price impact on pipeline delivered gas. For example, at the Algonquin City Gate gas in January, it's above $22 in New England. Is EIA conducting any analysis on price impacts on domestic natural gas as a result of LNG exports and this sort of explosion? And I would throw in, what about Canadian LNG exports as well? Clearly, it looks like this market is not totally decoupled. I'll just put it that way. Do you have any comments on that?
Yeah, so I mean it's certainly we're looking at prices as we know, kind of across the region. STIO doesn't have, so STIO only forecasts a Henry Hub price. In terms of the forecast, we don't have a forecast for, say, Algonquin or other hubs. But as the question noted, that obviously kind of where those hubs sit in relation to the market in the U.S. does have a big factor on kind of prices. However, again, kind of in our general market monitoring and things we do take into account, we do analytically take into account kind of prices all over the country and in different hubs. In our analytical kind of, I would say, qualitative assessment of the markets that we do on an ongoing basis, but it's not something we forecast explicitly.
Thanks so much, Tim. I appreciate it. And, it's probably a good segue to Ed Morris with Citi anyway, with maybe a global view to talk about some of these economic drivers. So without further ado, Ed, I'll pass it to you.
Thanks very much. And thanks for inviting me to participate in this, and good to see Tim and other people here. As you and Ben indicated, Megan, at the beginning of your remarks, the world we live in now is very different from the world of 5 years ago, and certainly anything longer ago than 5 years ago. The U.S. is really part of a global system now. We see it on the export side, but we also see how U.S. prices are impacted by what happens in the rest of the world. We're living under conditions which are stressful, where we're looking at the reliability of grid structure, the reliability of redundancy in order to make enough electricity when there is peak demand. And I would point out, just following on Tim's response in the last set of questions you asked on Northeast prices, that we had a very late winter in the southern part of the country last year. We had winter happening really in late February and early March. And the reliability of the system was such that we had prices shooting up, not to $30 per million BTUs, not to $100 per million BTUs, but to $1,000 per million BTUs because of stress in the system that we expect to happen again this year. But as I said, you introduced me as someone who's going to look at global uncertainties, and this is a year in which what's happening around the globe has had an impact, but we're relatively sheltered from it. As we can see on the first slide after this cover slide, prices on the left side of major global natural gas benchmarks have really gone parabolic. And they've gone parabolic through July, August, through September and October. Have they peaked? Probably not. We thought they might have peaked in the first week of October, but since the first week of October, natural gas in Asia has gone up again, and natural gas has been able to push coal prices up to $300 a ton, threefold where they were earlier in the year. And look at where US Henry Hub is. So, we know the shock of doubling from $2.50 to over $5 per million BTUs, but the US has decoupled from the rest of the world because of limitations on the amount of LNG that can be exported out of the country and limitations on the amount of pipeline gas that can be exported out of the country. So things are bad here and things could get worse, but we are incredibly better off in some respects from the rest of the world. On the next slide, we can see how there are still dangers in the rest of the world that could come back and haunt us. And the biggest dangers are really blackouts on the one hand, and the shutting in of energy-intensive industry on the other hand. Blackouts will make people very unhappy. We're having rolling blackouts in China. We're having some blackouts in Europe, particularly in the United Kingdom, because of lack of grid reliability and substitutability of one fuel over another. And when you have blackouts, they bring political problems. And when you have blackouts, one of the political responses is to shut in energy-intensive industry, which is happening in China and already happening in Europe. One of the things we can't do in the hydrocarbon markets is what central banks can do in dealing with problems at home. They can print more money. You can't all of a sudden create more natural gas or more coal or more propane or more crude oil. And there are not very many supply levers to pull on that can release incremental supply into the market. I would note, and this is a very important thing in terms of an ongoing conversation about where electricity markets are going, look at reservoir places around the world, including in the United States, in Latin America, in Europe, and in China. They're low. In this chart in particular on the right, Nordic hydro capacity as a percentage level being around the 50% mark. And this has happened to put at a time like now, where the reliability of hydro is questionable, putting more strain on fossil fuels, and where the reliability of wind, believe it or not, is also being questioned, particularly in Europe. On the next slide, we have a look at China's power crunch, which is adding to coal cost increases around the world and adding to stagflation around the global economy, a danger that I would point to for the US indirectly. But we've seen China coal prices tripling year to date with no sign of any alleviation in the way. And part of that is because China had flooding weather conditions that flooded coal mines that have shut them in and can't be brought back. And this has predated the onslaught of winter, as we can see on the right-hand side. Chinese coal inventories at coal-fired plants are at the lowest level since 2014, a period of time since which demand for electricity has gone up at high single digits, if not double-digit rates. So another aspect of this is that the power crisis in these other countries that are affecting the US is driving up production costs while we have material shortages. And just as an example of that, where we are impacted because China and Europe make aluminum, the US makes aluminum, but also imports aluminum. Aluminum had been costing around $2,500 a ton toward the end of summer. Aluminum, when I did this graphic, was costing $3,200 a ton. Aluminum this week is $3,500 a ton, record levels. And they're at record levels because China, and in some cases, European aluminum is being shut in, as is copper and as is steel. And that's because the cost of producing aluminum have gone up. The energy cost of producing aluminum in Europe today is about $4,000 a ton of created aluminum. And the aluminum is selling for $3,500 a ton. So what does one do if one has a plant? One shuts it in. So therefore, the impact on energy intensive metals is impacting the US economy in ways that we haven't discussed in our look at where the winter fuels outlook is. But it's a kind of double whammy that impacts inflation in energy costs and impacts industrial expansion as well. Natural gas prices, as we see on the next slide, have peaked temporarily, but they could spike much higher later on. And as we look at European, one more slide, please. As we look at European inventory levels under 30 years worth of temperature, we could see US inventory going down not just to zero, but actually pulled to below zero levels, which means that European prices already high can go significantly higher, 2 or 3 times higher, depending on weather conditions. Back to the US on the next slide. Yes, the US market is tight and could remain so because producers have been maintaining capital discipline. There's no doubt that we've seen lower 48 dry gas production falling in both the Northeast and in Texas after being largely flat for the first 8 months of the year. That's due in part to maintenance, but just as we've seen US oil production falling from a peak week of 13 million barrels a day last winter to a little over 10 million barrels a day twice, once in the late winter with the freeze-offs and then in the hurricane season, we still have US oil production below where it was at an average of last year. We're at around 11.5 million barrels a day, 1.5 million barrels a day down from the peak. A lot of that gas, particularly in Texas, is associated gas. So one of the stresses in the gas system is not just the lack of drilling. And you can see the rig counts on gas having risen very, very slightly on the right-hand side, not yet responsive to prices. But natural gas production this year is modest because, in part, not only of the drilling level, but because associated gas production is down. We think that's going to change next year dramatically. And not much can be done about it this year as producers have been restrained in their spending on new production. This is happening, going back to the industrial side of things, as we can see in the next slide, at a time when the US recovery from the pandemic has been as robust as that of any other country. So industrial demand for fuels has also risen at the same time that we've had a very strong pull, as noted earlier, on US LNG exports and in addition to that, on US pipeline exports to Mexico. One of the good news is that as we move into winter, Mexico's pull on US natural gas by pipeline ebbs significantly. It should be going down from around 6.5 billion cubic feet a day peak in September to around 4.5 billion cubic feet a day if what's happened is true to history. On the next slide, we note that, yes, U.S. natural gas inventory levels are not as high as they have been, but they're much healthier than the rest of the world. I'd now like to skip as fast as you can to slide number 18 to look at some other aspects of the U.S. market, and in particular to answer questions about what can be done, how do you make more crude available. One way is to get the rig count up, and we're certain that the rig count is going to rise. The problem with the rig count rising is that there's about a 6-month lag between increases in the rig count and increases in gas production. So while we expect that there's going to be a healthy increase in rig utilization in the fourth quarter of this year, November, December, and the first quarter of next year, we won't see the impact of that until we get to the middle of next year, where we expect natural gas production to be significantly higher, which is one reason why we expect that there's going to be more gas available next year, just as we think there'll be more oil available next year. And as we look at those balances and look at the US versus other countries, I'd like to move quickly for my final remarks to slide number 28. And on slide number 28, particularly on the graphic side, we can see that if we go back to the latter part of 2020, at the latter part of 2020, we had just under $3 gas at Henry Hub, as last year was closing out in the winter. We had $5 gas in Europe, $2 above Henry Hub, and that's because the gas arb out of the United States at a time when European inventories were normal, were about $2 per million BTUs higher than in the US. And in Asia, about another $2 higher. So the spread across the planet was from just under 3 in the US to 7.5 in Asia. Look at the price differences now, where we have basically $5 Henry Hub gas in the US, $32 LNG prices in Europe. And that's down a little bit from 35 a week ago. And European prices are at $30 per million BTUs. European prices have skyrocketed above where US prices have been. We expect that there's going to be, because of the rebalancing that I suggested, coming out of incremental drilling in the US, that even if we get to $6, which is our base case for Henry Hub this quarter, depending on where weather goes, or $7 in our bull case, by the time we get into next year, we can't imagine prices being higher than a little over $5. And by 2023, we'll be back toward the $3 range in the US in our base case, perhaps as low as normal, $2.50 to $2.70. So we're seeing that happening in natural gas. On the oil side, I would note that for the world as a whole, normally diesel, propane price, diesel prices in particular, are higher than natural gas or coal. For the world as a whole, natural gas prices are now higher than diesel prices, and coal prices outside the United States are higher than diesel prices, which is also pulling diesel out of the US pool and making that price go up more than would otherwise be the case. One final remark on oil, where we see $85 Brent right now and $82 WTI. We expect that these prices are going to come down significantly past the winter, not just as OPEC plus countries bring more oil back into the market. It may be 400,000 barrels a day per month. It may be a higher level of that at these prices as we get to the next OPEC plus meeting on November 4th. But we're also seeing very strong rebound in US production, in Canadian production, in Brazilian production, and production in the Caribbean and Suriname and Guyana, production in Norway, and production in Kazakhstan and potentially in Russia. So we're looking at prices going from the $80 level, not just to the $70 level, but to the $60 level in all likelihood in our base case for next year, which should make the year after this winter a lot better for consumers than this year. And thanks very much for having me here, and I'm happy to answer questions now or in the Q&A period later on.
Thank you very much, Ed. And I think we will, for the time's sake, we'll go ahead and move on and then do some questions, because there are some that I think we can get back to and address as we get down to the open session at the end. So with that, we will move on to our next speaker, which is going to be Rusty Brazil, the founder and CEO with Principal Energy Markets, or better known as RBN. And thank you for joining us, Rusty.
All right, thanks, Ben. Can you see my slides?
Yes, sir, we can. You're up and ready.
That's good news. Well, I certainly appreciate the opportunity to join you guys this afternoon. The title of my presentation here is Running on Empty. So that was February of 1978 for you Jackson Browne fans. Before you accuse me of overstating the magnitude of what's going on in the propane market, don't take the title literally. We've got 72 million barrels of propane in primary storage, according to last week's EIA numbers. And that's a long way from empty. But, as we just heard from EIA, there's certainly a potential problem out there. Propane stocks are lower than they ought to be going into the winter season. And one of the most significant factors responsible for that is exports. Instead of filling storage here in the United States, a lot more propane's been moving overseas. That situation is not new. It's been coming at us for a while. But the result is that, sitting here in October, stocks are about 30% below where they were last year, and exports are still going strong. It's too late at this point to build any more inventory. That's already done. Seasonal withdrawals are already kicking in. It may not end up being a problem. If David's weather forecast turns out to be accurate, we're probably good. But there's certainly no doubt that we're going into this winter looking at the most precarious propane market conditions that we've seen in a very long time. Here are the cliff notes on my presentation. If I can get my clicker here working. There we go. Hold up. One moment. For some reason, my slides do not seem to be advancing, Campbell.
Do you want us to run them on our end, Rusty?
Let's see. Hold on. Nope, I've got it. There we go.
Great.
All right, cliff notes. Propane prices are high. Gulf Coast prices haven't been at this level in October since 2011. Exports are strong, averaging in the neighborhood of 1.2 million barrels a day. For those of you who like to think in gallons, propane guys do, ratably that would be over 18 billion gallons a year. That would be a lot of exports. Inventories are low, running below the minimum level we've seen in the last 5 years. And as a result, worry is increasing. Specifically, going into the winter season with low inventory levels, what happens if we hit a sustained period of cold weather? Sure, the prices could go higher, but even more worrisome is what happens in terms of the potential for supply disruption, meaning that the impact on folks that count on propane to stay warm. What happens if the supplies don't show up? It certainly happened before. And this year, such a scenario is probably more likely than we've seen it in a number of years. So we'll start off with a few slides that will help put the propane market situation in the context of what's happening in other energy commodity markets, specifically crude oil and natural gas. And Ed talked a bit about this, but this is a little different approach to looking at the numbers. For crude oil, after rebounding after last year's crash, crude oil prices basically doubled. They were $40 about this time last year. Now we're just above $80. Big increase, still well below where we were in the pre-$1,400 a barrel timeframe. Natural gas up from around 275 this time last year to a little over $5, a little weaker over the last few days, but still almost double. And then there is propane running around 53 cents this time last year, now up to at least yesterday at $1.49, 149 cents a gallon, so triple. So crude oil double, natural gas double, propane triple. Clearly, there must be something that's different in the market conditions for propane than it is for crude and gas. And the obvious first question is, has the production of propane been cut back more than the other two commodities? Well, here's crude oil. This is crude oil since 2019. Things were rocking along just fine until COVID, getting up to 13.1 million barrels a day. When the pandemic hit, crude oil production dropped like a rock down below 11. And that's where it stayed for basically a year, continually to getting whacked by hurricanes and, of course, the February deep freeze. In the past few months, production's clawed its way back to 11.4 million barrels a day, but still 13% off the peak. Trend line that you're showing here is obviously down. Same time frame for natural gas. It fell during the initial COVID outbreak, but only from 95 BCF a day. This is lower 48 numbers down to 85, or about 10%. And then it started coming back, interrupted by hurricanes and the deep freeze for sure, but still rocking along 90, 92 BCF a day, only about 3% lower than the peak. So a lot of reasons for this, both economic and geological, but there's no doubt that it happened. The trend line over that period of time is basically flat. And then there's propane, which of course it's produced mostly from natural gas, not from crude oil. And no surprise, propane production has performed better than crude, but it's performed better than natural gas too. Propane production is actually up, not down over this period of time, by about 15%, in fact, since the low of the COVID meltdown. So there's several new processing plants that have come on. NGL prices have been high, making recovery advantageous. A lot of other factors that have helped goose the number, which has been actually good news for propane market. So we can conclude that propane production is not what is pushing the price higher. And domestic demand is not the culprit either. We'll look at that in a minute, but consumer and petrochemical demand for propane has been flat for years. So it must be something else. So let's take a look at exports. And to put our three commodities markets on an apples to apples basis, let's look at exports as a percent of US production of each one of those commodities. First, crude oil. Volumes took off after the ban on non-Canadian exports was lifted in December of 15, ramped up to about 24% of production in 2019. This year, exports have averaged about 27% of production. So healthy increase. Natural gas exports, as we've heard in a couple of the remarks earlier, have been ramping up steadily since the first LNG terminal came on in 2016, adding to the pipeline exports that already, of course, moved to Mexico. And by the way, Canadian exports are excluded here since we actually import more from Canada than we export. So this year, using this measure, exports are up a lot, but still only about 17% of production. Propane is an entirely different league. Back a decade ago, propane exports were in the 17% range, but over the 2013 to 17 timeframe, huge expansions of dock capacity enable exports to increase up to 60% of production. So far this year, exports are running 67% of production. So let me be clear about what this graph is telling us. The US now exports more than twice as much propane as we use in this country. And that includes both consumer demand and petrochemical demand. The bottom line then is that exports now dominate the US propane market. Now, before we start blaming the exporters for the current market conditions, we need to step back a minute and see just exactly why propane exports have increased at such a rapid rate in the first place, and why all that dock capacity got built to enable those exports. The underlying culprit was really not exports at all, it was shale. So let me show you what I mean on this graphic. Starting 10 years ago, the production of oil and gas from shale jumped, and that basically jump-started propane production from natural gas plants. That's where the majority of the growth has been coming from, increasing from about 600,000 barrels a day in 2011 up to 1.7 million barrels a day in 2022. And on top, in 2020. And on top of that, propane from refineries stayed relatively constant, declining just slightly in recent years. This is the propane demand from the consumer market and petchems. So demand has hardly budged. It's been basically flat. So the propane market simply had no choice. The surplus barrels that were being produced because of what was happening in the shale had to be exported. Otherwise, there would have been no place to put all that propane above that green line. And that's exactly what happened. Propane exports, the red line, increased almost barrel for barrel at the same rate of production increase. The purple line on that right scale is the same percentage that we looked at on that previous slide, now approaching 70% of production. It was the only way for the market to balance. So all of this US propane hit the international market, and the international market responded exactly as you would expect them to. They built more facilities, more demand in order to be able to absorb US propane. They built steam crackers, ethylene plants. They built propane dehydrogenation plants. They expanded retail propane networks. All of these facilities built in the built across international markets, they now all exist. And they're counting on the US to be able to provide their supply. By far the largest market for US propane is Asia. Now takes up about 60% of all overseas propane exports, with Japan, South Korea, and China making up the lion's share. Here's an interesting fact. More US propane goes to Asia than to all the consumer markets in this country, more than all residential and commercial demand in the United States goes to Asia. Latin America and the Caribbean still absorb a lot of barrels, about 27%. The other big market is Europe, about 12%. These global markets are far larger than they were back before shale. And when markets in these parts of the world get tight, they're going to pay up to maintain their supplies exactly as we do here. And that's exactly what's been happening all year long. The reason why propane prices are up as high as they are is international buyers have been holding on to their supplies of US exports by basically paying whatever it takes. You might think that the market impact of all of these exports would be confined to areas of the country where the docks are located, on the ocean, not up in propane country, what EIA calls PADD 2, the Midwest and the Mid-Continent, where about 40% of all consumer propane demand is located. Lots of rural residents, lots of cold weather. So shouldn't PADD 2 be relatively safe? Unfortunately, not so. A lot of propane moves south out of PADD 2 into the Gulf Coast as part of a mixed stream of NGLs called Y-grade. These volumes are moving mostly to Texas to be processed, and then the propane exported. Because the propane is part of a mixed stream containing ethane, butanes, natural gasoline, it's very difficult, if not impossible, to turn those volumes around and go the other way if it gets cold. It's a similar problem up in the northeastern part of PADD 2. Volumes come from Ohio to be processed into Pennsylvania. They're exported out of the Marcus Hook terminal in Pennsylvania. That's propane. And west, volumes that previously moved from Canada down into PADD 2 are now increasingly going to propane export facilities in British Columbia and a terminal right across the border in the US at Ferndale, Washington. Canadian volumes were also cut back by a processing facility fire a couple of weeks back. The implication is that PADD 2 inventories are tight, even though the propane exports are moving out of terminals on the coasts. All that said then is here's where inventories sit today. The numbers are from last week's EIA inventory report for the week ended October the 8th. This is the 5-year inventory range for U.S. inventories. For this time of the year, about 76 million barrels a day on the low end, up to 101 million barrels on the high end. Last year at this point, we were pretty close to the high end at about 100 million barrels. This year, it's exactly the opposite. We're below the low end at about 72 million barrels based on our projections that I'll show you in just a couple of minutes. We'll be below the 5-year minimum throughout the winter. That's the U.S. as a whole. It's even more worrisome up in PADD 2 because the area is just simply more susceptible to periods of sustained cold weather. There in the what we think of as the heart of the propane country, inventories are under the 5-year minimum at about 25 million barrels. Stocks have been increasing, but just not as fast as usual, not as fast as you would expect. And so the big question is whether or not it's going to be enough. One other wrinkle, by the way, in this year's propane market that makes that question of will it be enough particularly difficult to judge is the forward curve of propane prices, the price of propane on the futures market going out over the next couple of years. This is the forward curve as of Friday of last week. Price over the next few months out until December, somewhere in the 140s per gallon. But then starting in February, the forward curve drops like a rock. The shape of that curve is called backwardation, which means that the price in each month in the future is lower than the month before. I want to emphasize that this curve is not our forecast. It's not anybody's forecast. It's just the price that players in the futures market are willing to do today for propane to be delivered in the future months. This curve has big implications for anyone holding inventory into the 2021 winter months. If you get stuck with unsold volumes at the end of the season, the market expectations are that the value of your inventory, expensive inventory, that value will be crushed with obvious harsh financial consequences for any company that lets themselves get caught in that situation, which means propane marketers cannot store barrels at today's prices and then lock in higher sales prices in the future, at least not where that curve is shaped today. And that's just one more factor that's keeping propane inventories lower than in previous years. Even with market conditions the way they are, we're still not predicting a crisis this winter, assuming normal weather, like David showed us. This is our outlook for propane inventories out of our supply demand model. Note that these numbers that I'm showing here are propane only numbers. Makes the graph look a little bit different than the one I showed earlier. That's the weekly numbers that EIA does include both propylene and propane. This is the 5-year range for inventories for the last few years. Same basic story we looked at before. The red line shows monthly inventories so far this year and our forecast for the remainder of 2021 and into 2022. So staying just below the 5-year minimum throughout the winter season. Now, keep in mind that we are showing here a normal winter weather, and we're showing exports at about the same level they've been for the past few weeks. So if inventories are going to be staying low throughout the winter season, which means that the market will be considerably more susceptible to hiccups if we happen to get a period of sustained cold weather. So let's get to the punchline. This is one statistic that the industry has relied on for decades. That's called days supply, meaning how many days worth of supply are in U.S. inventories at current demand. The calculation that I'm showing here is what EIA actually calls days of disposition. Warren has made sure I get that terminology right, which is simply the total of stocks divided by the sum of domestic demand plus exports. So what we're doing is we're comparing month to month how much propane we have in storage versus how much is going to the market, whether that market is in the US or somewhere else. So this is the 5-year range, and this is days supplied for last year, about in the middle of the 5-year range, at least until the last few months of the year. This is what it has looked like so far in 2021. Last week's EIA numbers calculated out to be about 29 days or about 10 days below the 5-year minimum. And this is our forecast for the rest of the year. So staying below the 5-year low, but again, like I said before, this is based on normal weather and moderate exports. So, these days, normal weather seems like a relatively optimistic scenario. As far as that goes, moderate exports probably optimistic too. And it doesn't take much cold weather, and it doesn't take much of an increase in exports for the market to lose several more days of supply. And every day out of the equation makes the outlook look a little bit more dicey. Unfortunately, that's not the end of the story. Days in storage, that metric is looking only at primary storage, large storage facilities at major hubs. It's a long ways away from that primary storage to the 230 some odd supply terminals that dot the landscape, along with the hundreds of bulk terminals in the propane industry. That's where any problem in upstream inventories can really get compounded many times over. So we'll walk through a very simplified propane logistics network to explain how that works. Let's say this is the border of a state in the Midwest. We'll call it the state of confusion. It has 2 major propane supply terminals. Terminal 1 in the east has a pipeline, gets pipeline deliveries, has about 40,000 gallons of storage. Terminal 2 in the west is on a rail line, about 80,000 gallons of storage capacity. These 2 facilities provide truck barrels to a number of bulk terminals, one of which we'll call A, with 1 million gallons of annual demand, the other B with 2 million gallons of annual demand. But for both facilities, demand is super seasonal. January demand runs about 8 times July demand. The primary source for bulk terminal A is terminal 2, about 80 miles away. If things get bad and terminal 2 runs out of propane because of a severe cold wave, terminal A can go a little further, 100 miles to get gas supplies, get propane supplies from terminal 1. More trucks and more drivers will be required because they have to drive further. But no doubt, and for that matter, depending on what happens in the winter, lines are probably going to be a lot longer than terminal 1 when they would be otherwise. But the situation is manageable as long as the severe cold weather doesn't last all that long. Terminal B, though, has a much bigger problem. Demand is higher, but its primary supplier, terminal 1, is only 50 miles away, which is a good thing unless terminal 1 runs out of propane. Then bulk terminal B's got to come up with enough trucks and drivers to go 200 miles all the way to get supply from terminal 2. Who knows if B can get the trucks? Who knows if B can get the drivers to handle those kind of delays, not counting what kind of lines are going to be at terminal 2. The point is that whenever cold weather hits and inventories are low, terminals can run low or run out. When that happens, logistical problems domino to the truck fleets and drivers, sometimes resulting in severe shortages at bulk terminals, which translates directly into homeowners who are trying to stay warm during severe cold weather events. That's exactly the kind of cascading supply chain failures that happened during the polar vortex of 2013 and 2014. And the longer the cold wave lasts, the worse it gets. Now, please, nobody on this call panic. My intention in going through this scenario is not to indicate such a failure is likely to happen this year. There's a good chance that the market's going to make it through the winter just fine, as long as we don't hit a sustained bout of frigid weather in the middle of propane country. But it's equally true that the propane market is more susceptible to disruption than it has been in years. And combine that with challenges of having drivers and general supply chains difficulties from COVID, it's clear that this is not the year that you want to mess with Mother Nature. So one last comment For states, governments, and regulators, the message is be prepared. Encourage propane retailers to build inventories, shore up your firm supply contracts, and buy early. Be ready with hours of service waivers for truck drivers. Get the message out to the media that homeowners need to get their tanks filled and keep them filled. And most importantly, do everything that you can to support the men and women that work that last mile in your communities. These folks are ultimately the folks that make the difference in how any chaotic market situation is going to get handled. Thanks very much for asking me to join you.
Well, thank you very much, Rusty, even though it's, as a Wisconsinite, it's not what I want to hear. And those were the Canadian exports I wanted to talk about in terms of, we do import about 40% of Wisconsin's propane from Canada. So watching those new terminals on the western side of Canada sort of taking liquids off has been a fun summer sport. However, we are getting close to the Q&A portion, so I will not derail us. I want to turn it over to Matt from US DOE CESER and Kevin DeCorla-Souza from ICF to give us a brief update from DOE's perspective.
Yeah, thank you, Megan. So Matt Charbuono, I'm with the Office of Cybersecurity, Energy Security, and Emergency Response at the U.S. Department of Energy. You can go ahead and go to the next slide. I'm just going to start with a quick, and you can skip one more, quick background on CESER and who we are and sort of what we do. And then I'm going to turn it over to Kevin to just run through a couple of our waivers in a little bit more detail. So the Office of Cybersecurity, Energy Security, and Emergency Response, which we call CESER, is the office within DOE that manages DOE's responsibilities as the Sector Risk Management Agency, formerly known as the Sector Specific Agency, and as the Coordinating Agency for Emergency Support Function 12 under the National Response Framework. We focus and cover all hazards. So anything from a cyber incident to a natural hazard to a man-made incident falls within the purview of our office. And we have elements that are looking at both the preparedness side as well as the response and recovery side, as well as a team that is also focused on R&D efforts and some long-term projects to help mitigate risk and understand various risks more completely. Kevin and I are on the response and recovery side. To accomplish our mission, we work very closely with our interagency, state, and local partners, as well as our industry stakeholders, since the majority of energy infrastructure across the US is owned by the private sector. As part of our mission, we maintain a robust situational awareness program, looking to monitor any issues that are affecting or potentially affecting the energy sector. That includes doing some short-term and mid-term analysis of impacts and how impacts might cascade into the region or into across the nation. And we really just look at the sort of immediate after an incident or after a potential incident, but we leave the long-term forecasting to our colleagues on the EIA side. But that said, we work closely with EIA whenever we're doing any sort of analysis to obviously utilize their data and make sure that we're well coordinated on our approaches. Currently, we're still in the midst of hurricane season, as you all know, but obviously we are approaching the winter fuel season, also in the midst of the harvest season. And so we're working with our partners to ensure that we have a full awareness of how fuel stocks look going into the winter and the potential concerns and constraints that are going to impact availability, much of which you've heard from the last three speakers. So going into this winter season, as part of our mission, we have already had conversations about preparations with various state and industry partners, and those will be continuing over the coming weeks. We're also working with across various offices in DOE and our interagency partners to make sure that if any potential issues do arise or are identified in advance, that we can look at what are the best options to prepare to respond to help mitigate or to help alleviate any impacts from any issues that do arise throughout the year. And we're certainly looking to incorporate lessons learned from previous incidents. Most recent, obviously the winter weather that affected portions of the central US last February, specifically or especially in Texas. Not sure what the next slide you're going to have, Campbell, is, but go ahead and advance. You can skip this one. So this is just quickly sort of what we do and don't do. And sorry about the spacing. We were moving things from different PowerPoint presentations. You know, I think the key thing is to focus on what we typically don't do. But I'll touch quickly on what we do. A lot of that is assisting our state, local, tribal, and territorial partners with restoration efforts and with damage assessments. We are not out there, or don't have the people out there stringing, conductor or repairing poles normally, though we have supported that through our power marketing administrations in the past. But we're really looking to alleviate any barriers that might be prohibiting or delaying response, to try to keep things moving as quickly as possible. Through our situational awareness program, we also try to provide quick triages of post-incident impact, things like satellite imagery and damage detection, to try to help our response partners identify where they need to go, and collecting and sharing information across all of the various partners. As I mentioned, we're not typically physically rebuilding the grid or components of the energy sector. We also, I think most importantly for this conversation, we don't normally determine prioritization. That includes priority restoration. That's something that's normally coordinated at the Public Utility Commission level, though we can certainly pass along information during relevant incidents about things that do need to be prioritized or considered and why. We don't normally prioritize fuel distribution. So just wanted to mention those upfront to sort of level set as we go through the conversation. But as I mentioned, we do work with our partners to figure out how we can help expedite responses or help mitigate impacts before something even happens. And if you go to the next slide, we do have some key inherent authorities that are within the department. Kevin is going to touch on two of these a little bit more completely, but the Federal Power Act, Section 202C, these are orders that are related to the reliability of the electricity grid, where we can require performance of certain activities or certain interconnections. Section 215A, this is what you might know as the grid security emergency. This is a fairly extraordinary authority that is delegated to the Secretary of Energy once the president declares that a grid security emergency declares a grid security emergency, then the secretary can issue grid security emergency orders. The key thing to note about a GSE order in Section 215A is that it is only applicable for man-made disasters as well as space weather. So it is not applicable for traditional natural hazards like a cold weather event or a hurricane. DOE is also delegated authority under the Defense Production Act, and priority ratings can be applied to certain contracts when certain criteria are met. And then we also have authority under the Natural Gas Policy Act related to a supply and export of natural gas and interstate commerce of natural gas. I also wanted to mention the Strategic Petroleum Reserves. Obviously, we have the overall Strategic Petroleum Reserve, the oil reserve at 4 sites along the Gulf Coast. And then we also have the Northeast Home Heating Oil Reserve, NEHOR, which is in 3 different points in the Northeast that Kevin's going to touch on a little bit more, as well as the Northeast Gasoline Reserve, which is mainly located in the New York Harbor area. These are, I'm just laying out the various tools that we do have. In addition to the tools that DOE has, we also work closely with our interagency partners for any relevant waivers that they may be able to issue. And we are the consulting agency on a number of those waivers. That includes things like hour of service waivers, regional hour of service waivers, national hour of service waivers from the Federal Motor Carrier Safety Administration, any waivers pursuant to pipelines from PHMSA, and then Jones Act waivers from the Department of Homeland Security, and finally, fuel blend waivers that you often see issued following a hurricane that are issued by EPA. But I'm going to stop there. That was sort of an outline of our broad authorities and our broad mission. And I'm going to turn it over to Kevin, who's going to talk a little bit more specifically about 202C and how it was used in California or in Texas, and the Northeast home heating oil reserve. So Kevin?
Hi, next slide, please. Okay, so actually I'll first speak a little bit about the Northeast Home Heating Oil Reserve, which was established in 2000 as an emergency stockpile to provide heating oil cover for approximately 10 days of Northeast home heating oil demands, which is about the time that it takes to load a tanker in the Gulf Coast and ship it to New York Harbor. So most of US heating oil demand is concentrated in the Northeast region. In 2019, the Northeast consumed 69 million barrels of heating oil, which was about 86% of total US heating oil sales. And the top 5 consuming states were New York, Pennsylvania, Massachusetts, Connecticut, and Maine. Today, the Northeast Reserve currently holds 1 million barrels of ultra-low sulfur diesel at 3 locations. And you can see those locations here on the slide. 400,000 barrels are in Revere, Massachusetts, which is in the Boston area. 300,000 barrels are in Groton, Connecticut. And then another 300,000 barrels are in the New York Harbor area at terminals in northern New Jersey. The size of the reserve was purposely kept relatively small so as not to dissuade private industry from building inventories to meet normal fluctuations in winter heating oil demands. So the reserve is managed by the US Department of Energy, but emergency releases from the reserve come at the president's discretion. In the 20 years that the reserve has been in operation, it's only been used once, and that wasn't for a heating oil shortage, but after Hurricane Sandy or Superstorm Sandy, fuel from the reserve was released to supply emergency responders in the New York and New Jersey area. Okay, next slide, please. So on this slide, I'm going to talk a little bit more about the Federal Power Act, Section 202C. Which is an authority that the DOE secretary has to temporarily order connections of facilities and generation, delivery, interchange, or transmission of electricity. So what this means is during an electricity shortage event, entities, typically independent system operators or individual utilities, can request that the Department of Energy issue a 202C order which will allow them to turn on certain generating units in exceedance of federal air quality limits in order to provide needed power supplies during an emergency. So these units are existing generation units that have a certain capacity to produce power, but due to limits on their emissions, they are normally capped at how much they can produce. And so what the 202C order does is allow those units to at least temporarily operate at a higher capacity during emergencies. So in order to get a 202C order, typically DOE will require specific generation and transmission emergency conditions exist. And before getting the order, typically other avenues of balancing supply and demand need to be exhausted before the covered units can be turned on. So 202C orders can be requested during an emergency, or they can be done in advance of expected potential emergency conditions. So for instance, if grid conditions are already very tight in a specific area, and an extreme cold weather event, a polar vortex or a winter storm is forecast over the next several days, an order can be requested at that time in anticipation of the emergency event. Right now, DOE has established an email address, caesar@hq.doe.gov, where it accepts all materials related to Section 202C. If entities wishing to apply for a 202C order want to look at past successful applications, they are available on DOE's website. There is a hyperlink here in the presentation which should be made available after the webinar. Okay, next slide, please. So this slide just covers a few of the recent past uses of the 202C order. Since 2017, the order has been used 6 times, twice for the California ISO in response to hydropower shortages and extreme heat conditions, twice in the ERCOT region, once during the February 2021 extreme cold event, and then once to connect a transmission line following Hurricane Laura in 2020. And then in 2017, it was used twice, first for the Grand River Dam Authority in Oklahoma, and then once for Dominion Energy in Virginia. So just providing a little bit more detail on the uses of the 202C order this year. In February 2021, as you all know, an extreme cold weather event affected essentially the entire central region of the United States, down into Texas, resulting in a loss of generation capacity in the ERCOT region. At the same time, demand was high due to the extreme cold weather, which forced ERCOT to initiate rolling blackouts over a period of approximately 3 days. So during this period, ERCOT applied for a 202C order, and DOE gave out the order, and that allowed 30 oil and natural gas firing generating units to operate, making approximately 1,800 megawatts of additional generation capacity available for ERCOT during that emergency period. And then the second order that was issued this year was just last month for California. And this was in response to a potential electricity shortage due to an ongoing drought severely impacting hydropower production in combination with wildfire activity shutting down transmission lines for importing power into the state, as well as the potential for extreme heat wave conditions. The order allowed only around 230 megawatts of generation capacity to come online, but that included 4 mobile generators that the Los Angeles Department of Water and Power had purchased and moved into the region in order to address the power shortage. Okay, next slide, please. All right, so as Matt noted earlier, there are a number of other authorities and waivers that the federal government has to address energy shortages and energy emergencies. I'm not going to go into all of these here, but I do want to note that the DOE has an energy waiver library available on its website where you can find more information on these waivers. All right, next slide, please. Okay, and then just
Kevin?
Yes.
Yeah, we're gonna have to cut it there, Kevin. We're coming up onto the end, and sorry to have to do that. That's not what certainly want to, but we did want to give at least an opportunity for a few questions. And we'll start with there was one for Ed that I skipped ahead so we could be sure to get all the presenters in. It's either Megan or Megan Gordon asked if soaring natural gas prices this winter will increase calls to limit U.S. LNG exports. The White House said they have no plans to do this. Do you think that'll stay true?
I do think it'll stay true. And the reason I think it'll stay true is because of the consequences of what might happen if the U.S. cut off LNG exports. So U.S. LNG exports are just short of 20% of total LNG traded in the world. And we are having a very delicate relationship with Europe at the moment over a bunch of issues. One of them is the Nord Stream 2 pipeline. So there is no doubt that if the US cut off LNG exports at a time when Europe is running low on its inventories of natural gas, it will have not small, but massive consequences potentially for relationships with major allies around the world. And I would note that the 10 BCF a day of exports is not particularly consequential in the end to the US market. It is fairly consequential to the European market. There are other things that could potentially be done. And we just had a speaker talking about the Jones Act. The Jones Act is a fairly controversial subject that's been invoked many times. The White House has had the ability to kind of ram it through regulators when the White House wants to do something that the regulators think is not within the regulatory guidance. But we do have a terminal at Cove Point, Maryland. There is a regas facility in Boston Harbor. I would point out that a couple of winters ago, and this is kind of normal in a coldish winter, for city gate prices in Boston to reach $100 per million BTUs. And the responsive party was Novatek, a Russian LNG exporting firm that had spare LNG cargo available. Now, I think the US government could talk to the terminal operators at Cove Point or other places and see what excess capacity there might be, or what excess cargoes there might be, or what could be diverted to a US New England port in the case of a real emergency. There are also, and I just want to note this, there are also ways that one could potentially discuss issues with the Mexican authorities or with the Mexican importer, because Mexico does have options on fuel oil and coal that could replace the LNG that's importing from the US.
Well, thank you, Ed, for that answer. And I think another good question that sort of evolves from that also for the whole panel is how much of the natural gas demand comes from heating household needs during winter? It's probably best for EIA. Versus like electricity production.
I thought it was on Tim's chart, actually.
Yeah. So what we showed on ours is residential, is for homes that only heat with for homes whose main heating fuel is natural gas. But in the first quarter, which is kind of has January and February, which are the peak months of the winter, your residential demand is about 25 BCF out of a 96 BCF a day market. So you're looking at a little over a quarter of the market during the first quarter.
Okay, and here's a fun one. Is there any concern among the panel attendees that we might experience another 2008 fiasco with world energy prices? Open to the crowd. Rusty, looks like you want to weigh in.
No, I'm happy to respond.
Look, why don't we let Ed?
Okay.
2008 was undoubtedly a bubble. I actually used that word in a publication I did. I was laughed off of a stage, and I was also kicked out of a couple of client meetings at the time. But we're looking today at a market, the financial market, that is a little bit more sophisticated than it was in 2008. The financial market of oil was just skyrocketing at the time, and a lot of parties were not as disciplined as they currently are. We currently have, even with these skyrocketing prices, managed money as a position of net length in the market is about at the average point that it is at. It's not overextended, it's not underextended. There is no evidence whatsoever that financial flows are playing any particular role on either LNG, either natural gas prices at Henry Hub, or on oil prices, either Brent or WTI. We've had a ratio now recently of about longs being around 7 times what the shorts are. That's normal because there are institutional investors that are naturally long commodities. And believe me, if you were long commodities for the last 6 quarters, you would have done better than being long bonds, long equities, long almost any other asset. So there is length in the market by virtue of a natural a dispensation or attitude of investors. There is nothing to say that anyone exceptionally is shorting it or is going long on it. And yes, should they be doing that? I'd say the most that we've seen on length, which was a ratio of just about 20-to-1 longs to shorts, had about a $10 a barrel impact above where we thought fair market value might otherwise have been.
And Megan, I just, since you asked me for a comment, I agree with everything that Ed said, but that doesn't mean that prices couldn't go where they went in 2008. They very well could, but it's going to be a weather-related event, not a financial-related event.
Thank you. Yeah, I think we're all bracing for that, particularly with Canadian propane supply being low and truck drivers being in short supply as well. As you noted in your presentation. Ben, is there anything else? I know we're over time. Thank you to the 200 plus people sticking around. Do we have another question for the gang?
There was another one about is why will U.S. crude oil producers become less restrained in their CapEx spending, or will they? Why will they become less restrained in their CapEx spending in 2022? Why do we expect that versus raise it now?
Well, if you look at U.S. Disciplined companies, the publicly traded companies have been remarkably disciplined. The private companies have been remarkably undisciplined. They're in the same Wild West that they were in 5 years ago or 8 years ago. And the private equity markets are making enough capital available for them to do that. Not only are the capital markets doing that on the equity side, but so are the bond markets, because the difference between kind of high yield companies, which most of these private companies are, and investment grade companies, the difference in interest rates is not very great. If we've seen a lot of capital spending by companies as percentage of the cash flow. And you can imagine that at $82 WTI, the cash flow is a lot better than it was at $40 WTI or $20 WTI or at a negative number of WTI. So they have been disciplined in the sense of keeping their capital spending at a budgeted level of positive cash flow. What they've been doing is buying other companies rather than increasing drilling activity. But they're about at the point of that where the cash flow is such that if they were to only stick to whatever that level of cash flow spending was going to be put into CapEx, the production would grow, and the not only would production grow, but they'd also be returning more money to shareholders. It is, I think, the consensus forecast that U.S. production growth next year, after a year in which it was negative by over 1 million barrels a day, that U.S. overall production, including natural gas liquids, will be upwards of 1.2 to 1.4 million barrels a day. And it looks as though the increase in drilling activity, which over the last month has seen added 12 to 15 oil directional drilling, that assessed number is going to be higher by the time we get there, given what I said earlier is a 6-month lag between contracting for a rig and actually seeing the production growth.
I would support that for a slightly different reason. I worked for a producer for 20 years. Producers produce, drillers drill, and I don't think they're going to be able to help themselves if prices stay at the level they are right now.
Excellent. Campbell, I see your face, which I think means we're all getting the hook. But thanks to our panel, really great discussion. I think we could have done this for another, I have many more questions for all of you, but, and our audience gave you a nice slate of questions as well. But yes, thank you so much for participating. And
for everyone that's still on, they will be sending out the recording link and slides to everybody that's registered for it. So, for the 660 that did register, they'll all get a link, and for the 300, I think at peak I had almost 400 So thank you to everyone that attended. We certainly appreciate it. And to our panelists, very much appreciate your expertise. Like Megan said, it's a brain trust. I could pick your brains all day. And with that, Kim.
Nothing further from me. Thank you, Ben and Megan, for moderating, and thanks to our excellent panelists for speaking today. Have a good week, everybody. Thank you all.
Thank you.
Apologies, DOE. It's hard to go last.